Welcome. In this video, we're going to discuss management of not only entries, but your exits. And we're going to do it in the context of divergence indicators along with our fibs and trigger lines. And a couple of key concepts for you. Divergence at Fibonacci areas will be very strong. 3 divergences in the same price area will be a termination condition, which you've already learned. A second divergence that's higher or lower than the first may cause a reversal. Before you actually enter a 5-1 trend trade, we're going to do comparisons of the small versus large trigger line locations. Whenever the small triggers are outside the large triggers, we're going to be able to take trades even though there's divergence on the pivot, and we'll take a look at a lot of pictures of this example. And then when the small triggers are inside of the large triggers, a divergence may reverse the trend. Now, we've used this picture, 10,000 times, and you've seen it 10,000 times. But just to clarify a concept and make sure, when we talk about small triggers being above the large triggers, pretty clear concept. That's the look for our trend trades, right? If this was our 13-2 chart. It's also going to be the comparison that we're going to make when we're watching for divergence. The one that for us that's going to be very important is when the small triggers get inside of the large triggers. And again, we always say anything can happen or you're losing momentum. But the small triggers inside the large triggers is going to be very important for what we're going to do with divergence. Quickly, this is one of our termination conditions, and again, we'll look at the bottom first. Any 3 divergences that are in a relatively tight or small range as far as price goes on the price scale, the third divergence will cause a termination condition for us. Likewise, one of our other conditions is if we have a higher divergence than the prior divergence, that will usually also terminate the trend for us. And it's true on the top and the bottom. If we have a 3 divergence configuration in the same general price scale, then the market will usually reverse. If any divergence is lower than the prior divergence, the market will probably keep going down. So that's a real powerful concept that we'll use a lot when we're watching not only our large charts, but our small charts as well. This is also in our management section of the material, but just to reiterate what we were talking about earlier, here I'll blow it up for you. If a divergence is lower than the prior divergence, the market's probably going to reverse. Now, there's another concept that we're going to introduce here, and again, we'll look at a lot of examples of this, but the example is, or the rule is, if the small trigger lines are located physically in between the large triggers, that's what we call weakening. Loss of momentum, weakening, inside. There's a lot of different ways you'll hear us say this in the classroom and in some of the videos, but short version is if the small triggers are located inside of the large triggers, any divergence can reverse the market. So it doesn't have to technically have 2 divergences or a higher divergence. It just literally any divergence that has the small triggers in between the large triggers could reverse the market, usually will reverse the market. And when I say will or usually will, what we're talking about is 75% of the time, give or take 5%. So it doesn't always do it, but most of the time it doesn't, and that's really what we're trading for, is most of the time. Now, this is from the termination conditions slide. You know these things already, but just to go over them really quick, a termination condition is defined as any Fibonacci area that may reverse the market. And then what we're going to be doing today is if we have a divergence from a Fibonacci line, that's going to be a powerful termination condition for us. I'll also want to make sure that you guys are also well versed on the trading the edges video, tops and bottoms video, and being able to quantify whether you have a good top or a good bottom in place before making trend trades. This is a slide from that video. And again, it's the ability for you to be able to quantify whether you have a good bottom, excuse me, such as a divergence from Fibonacci, or you have a pivot from nowhere, which would create a weak top, or if you have a second higher divergence from Fibonacci, which would also create another strong move. So you're going to really start to overlap this higher lower divergence, second divergences, divergences at fibs, divergences inside of triggers. All of these concepts are going to overlap, and you're going to be using them initially in the context of our trend trade rules, and more specifically the entry and the exit. So when we're talking about entries, we're talking about looking at our 5-1 chart, and from that 5-1 chart, trying to determine whether we should or should not take a trade setup. So what I'm going to do is I'm going to give you way too much to look at, and the reason I did it in this format with these pictures is so I could blow up specific areas and we can talk about them. So the first thing I wanted to do is I wanted to talk about 3 divergences from an area, which we just talked about as a termination condition, but this is how it would present itself on a 5-1 chart. Now, the concept of a higher divergence, meaning a divergence on the low and then a pivot with a higher divergence, would also reverse the market. Now, when we step back and we say, okay, well, we had a good bottom, that's nice. We can see termination condition, that's nice. But what we're going to be looking for is we're going to be looking for a trend trade after a good bottom. And, you know, there's 2 things that are going to end up happening on, you know, assuming you're going long. You're either going to have no divergence on a pivot, which is, you know, that's a really, really, really easy look, a very, very powerful look for us. Or you're going to have divergence on the high pivot, which is represented by this negative number. And what you're going to have to do is you're going to have to be able to look at your small trigger line location versus the large trigger lines and say, should I take a trade based on not only what this 5-1 chart is doing, but also having a good top, good bottom, and strong triggers on your 13-2 chart. It's going to be assumed at this point. So as we progress through this, we're just going to basically look at, you know, a simple concept. If we have divergence, are the small triggers outside of the large triggers? Because if so, then the trend usually will continue up. So we can kind of go back and start at the bottom and work our way forward. Number 1, we had 3 divergences at the bottom, and we had a second higher divergence, which caused the market to reverse up. At which point we had no divergence, but the small triggers are outside of the large triggers, which means we're going to have a trend trade long. As the market goes up, we end up with a divergence pivot, but because the small triggers are outside of the large triggers, we're going to have another trend trade long. And if the market breaks a fib, and even if we have divergence, it's not really going to matter as long as these small triggers are outside of the large triggers. Getting the pattern? Pretty easy, right? And as the market progresses up and you have divergence, you're going to ask yourself one more time, can I do another long trade? Now this one was starting to get to the point of weaker triggers in your 13-2 chart. And then you'll see, you know, in reverse, the same thing we saw at the bottom. We have multiple divergences in the same relative price location. I want to make one statement. Some people will say, ooh, a third divergence. And if you have a divergence and then a higher divergence and then a much higher divergence, that's not three divergences that will end the trend. So if you're getting consecutively higher divergences with the triggers outside, those don't really count. Only when you have multiple divergences in a relatively tight range, that's the types of multiple divergences that will reverse a trend. So, you know, if you're doing this last long trade, you're going to start recognizing where are the small triggers in relationship to the large triggers. And you can see very clearly the small triggers get inside between the large triggers. And we not only have pivot stop outs and we have lower divergences, but our small triggers are also below or inside of the large triggers, which tells us the trend is probably going to reverse to the downside. At which point you start, you know, let's just say hypothetically you made a good top and you're going short. So you're going to be at this point on your chart and you're going to say, okay, we're breaking a fib and we have divergence. Where are my small triggers in relationship to large? And you're going to say they're very much outside, so I'm really going to go short. And then if you go short, you're going to say, okay, I'm at a lot of blue fibs, which is not really great for going short into, but let's just say you wanted to anyway. You would say to yourself, with the second divergence that's higher than the first, and my small triggers being located inside of my large triggers on my 5-1 chart, the market's probably going to go higher. And lo and behold, it does. So if you were short, there's no reason to, you know, when we talk about stop theory, right? Let's assume you went short at the magenta midband, just for grins and giggles. And you get a down pivot and you put your stop above the down bar, which is the right thing to do. Now you have to say, should I leave my stop up here somewhere and get stopped out, knowing that I had a second higher divergence? Or would it be more advantageous to get out after up bars and not lose more than a couple of ticks? And again, you can go back and study this, but if you have a second higher divergence and the small triggers are inside, you will lose more money no matter where you put your stop. So don't put your stop up here and lose more money. Take your small loss and then wait for the next trade. And you'll see as you start to gain more experience with the software, you'll start to see these same two patterns. So before I show you the words, you can see what the pattern is, right? Divergence, and then a lower divergence, which means what? Well, it means that lower divergence, we're probably going to go down again. So remember where we were going short, or you were going short at the midband, and this higher divergence took you out. Well, now the divergences are saying we're going down. And this is where, you know, if you have continuation trades in your trading plan, this is where you'll take a short trade right here, which is essentially a continuation of this one that didn't work, and then you'll end up making your money. And then you'll ask yourself, you know, if you're in a short trade, you'll ask yourself, should I get out of my short trade when there's divergence? And you're going to say to yourself, before I make this decision, I'm going to analyze where my small triggers are in relationship to my large triggers. If they're outside, I'm just going to hang on for a minute and maybe make some more money. And then you're going to get a second divergence and go, should I stay in? And you're going to say, where were my small triggers at the time of the low? And you're going to say they were outside, so I'll stay in one more time, even though you're starting to watch it. And then ultimately you're making a third divergence. And at the time of the third divergence, without me actually giving it away, it's pretty obvious now, right? Third divergence, small triggers are inside of the large, there's no more reason to hang on to a short position, because 3 is a termination, and a divergence with small triggers inside tells you that the market's probably going to go back up. So it makes the management of your trades very, very easy. Let's look at another one. This is, I put this one in class in April. And again, it's a slightly different large trigger line. I was using a 13 range trigger line instead of an 8 range, but it doesn't really matter what chart, what market, what size chart you use. This concept works, period. So you can go study it on any chart, any market, doesn't matter. The short version is, after I check that everything on my 13-2 chart is true for a trade, strong triggers, good top, good bottom, in this case, good bottom, I like to check with 5-1 trigger location, right? And again, this is where if you're going to buy support or some area, you want to check on the high and say, where were my small triggers in relationship to the large? And then if you have divergence at the high, you're going to check at the time you're getting in, where are my triggers? Where are my triggers? And I won't bore you with this too much, but where are my triggers in relationship to the large? And then ultimately, I want you to see how this actually plays out at the high. I know we get to fibs, you're probably not going to take any more long trades, but just for grins and giggles, because the small triggers are outside the large, what if you took one more trend trade and then recognize that the small triggers are now inside the large? So you can take half off, get your stop down real tight, and then obviously with a lower divergence from fibs with the small triggers inside, the market's probably going to go back down again. So you'll start to be able to read your charts very effectively, and divergence will not take you out of a position unless there's a really good reason, like the small triggers are inside, or there's a higher lower, or 3 divergences. This is also from the tops and bottoms video when we talk about continuation trades. Right, we talk about in this video, and go watch it, I'm not going to go through it, but a weak top from the middle of nowhere, fibs are probably going to hold, and then the market's going to go up. And you'll start to see, the same concepts play out as far, this is a different scenario because we're going to try to get in after the trigger lines roll. The reason I put this in here, remember this picture that we had? I want just, ooh, I hit the wrong button. Sorry about that. I want you to see, and I want you to start thinking about, right? Let's assume that this is your continuation area, right, for that trade. And now, armed with the knowledge that you have, that if you have divergence from fibs at the low, and then you have a higher divergence, and you're looking to buy a pullback to your small triggers and maybe the green midband, now this becomes your entry after a divergence condition from a low that's going to tell you that the market's going to continue up. So, and again, I'm going a little bit more advanced here, but again, when you start seeing the continuation areas and you get a really favorable, very bullish divergence condition, think of the amount of money. Here, let's just put a number to it if I can get it. So 39.16, you're going long instead of 39.22, round numbers. So you're talking about being in 6 points earlier on the S&P continuation style before you ever get your first trend trade that you're going to take anyway. So again, this is where the extra money comes from in looking at Nexgen. When, we talk about continuation style entries, well, there's not just one look, there's multiple looks, and the better you are at reading your fibs, triggers, and divergences, the more you'll start to see these tops and bottoms that have continuation style entries that you can take. Now, realistically, I would like to see 2 charts worth of information from everybody when you start doing that. You can't just do it off of a small chart. So you have to have a large chart, small chart combination. Let's go forward with this lesson. And, you're going to find yourself in this situation a lot. Maybe you took a short trade and then you get into a 50-50 situation, which is defined in some of our other material. But 50-50 is very easy. Small triggers are below fib, large triggers are above. You're not sure what to do here. So let's look at the low and look at it from the context of what we now know about Fibonacci and divergences and things of that nature. That 50-50 low, we had basically a divergence, line, pivot, stop out, second divergence from fibs. So, let's just assume you took the first short. Because there's the termination condition on your 5-1 chart, you're not going to take any more trades with the 50-50 look on your other chart. And you're also going to start recognizing that because you have a higher divergence, right? 1, 2, 3, the third one's higher. And you're also going to say, wow, when I had that divergence, my small triggers were inside of the large triggers. You can pretty much bet that the bottom is in. And, again, I don't want to go too far into this, but you'll start to see as you start analyzing your larger chart, remember what we talked about, small trigger line location relative to the large triggers. Well, when you get divergence from a fib and your small triggers are above your large triggers, you're going to know it's a really good bottom. Not only because of the divergence, not only because of the fib, but you're going to also have the trigger line configuration in your head as well. So when you have a strong small versus large trigger, you're going to be able to take that trade a lot easier and not worry about this little red fib here. This red fib was great, but over here, right? Not when you have a good bottom and higher divergence pivots with the triggers above, this fib's going to break. So when we take that information back to our smaller chart, you'll see, the smaller chart always warns you before that a bottom is in. Multiple divergences, they're higher from the low, pivot stop out. Now we're taking trend trades, right? Because again, I want to back this out a little bit so I don't confuse anybody. We had a bottom, we had a higher low pivot, we have strong triggers. We're going to take a trend trade. The first must take trend trade. And this is what scares most people out of, or talks. I can say scared. It scares most people out of their first trend trades that they skip. And I see it every day over and over and over in our chat room. They skip the first one because they're like, well, I had this. And again, now that you have this newfound knowledge of looking at a divergence and comparing where the small trigger lines were relative to your large triggers and fibs here too, you're not going to be worried about taking this trend trade long because you have two things. Number one, you have divergence from the low on your large chart at fibs, plus you have strong triggers. So you have a good bottom with strong triggers. And this little divergence is not going to make you nervous about taking this long trade anymore, especially when the small triggers are that far above the large triggers. Now, as we progress up, I didn't even really, write anything on here about this divergence and these small trigger lines. That's obvious, isn't it? Now that you know what you know, isn't it really obvious that that divergence is inconsequential? It literally doesn't mean anything. It's almost as if you could just ignore it and take your trend trade, which you will start doing now. And as we progress up, you'll notice, again, the same pattern over and over and over. I'll show you the words if you want, but you don't need them anymore, do you? Divergence with the small triggers outside the large. You're going to take one more. Because the small triggers are inside the large triggers, not only that, the background color is red, you're going to know that if you make a new divergence after 2 bars down, you're going to be done with your long trade from over here. And you're not going to lose a bunch of money anymore because you're going to be prepared to defend your position very assertively. Maybe take a quicker target and then get to break even or plus. Right? You heard us say that a lot in class. Here's another such example. And again, real world examples are always nice. This was from June 29th in class. Posted this one in class. And again, we said it's a good top because there's a pivot stop out, but it's not a great top because it didn't come from anywhere. And we ended up talking about doing a short trade. And we also recognized we have 50-50 triggers, right? Larges are way above. Anyway, we said, look, it's worth going short once. I won't show you these words up here, but it was entered a little higher because of how far away the 13-2 triggers were. But short version is we decided to go short. There was no divergence on the low and the small triggers were outside, which is really a good look for us for taking one short. And we recognized that if the fibs 1-to-1s made a new divergence to the upside, there's no more reason to lose any money. Actually, the stop should come down another tick or two. And ultimately, this did make a higher divergence pivot. So again, when we talk about taking a trade and managing it tightly, either taking half off a little earlier or making sure that your stops come down if there's any divergence that might take you out of your position. Now, as we were talking just a little while ago, remember we said that if we have divergence from fibs, that's a very powerful condition for us, right? On the large chart. It creates a good bottom. And remember, we also discussed if we have divergence, pivot stop out from those fibs with the small triggers inside or above our large triggers, it makes it even better. Now your brain's whirling, isn't it? You're thinking, how can I jump on that a little early? Well, you can't if you're being conservative. So get that thought out of your head, right? We're not counter trend traders. Again, if it's in a trend up and you're doing continuation, then this would be okay to go continuation long. If you're in a downtrend, right, there's no way of knowing that you're going to get all these up bars after this. So if you're trying to buy here, you're going to end up really getting yourself into a lot of trouble, counter trend trading. So again, just a quick warning, we're not counter trend trading. If you're continuation trading with the existing trend, that's a different scenario. This is not to be applied for counter trend trading. Okay? Just getting it out there. So we have divergence and strong triggers, and we're going to do a trend trade long. And, again, this is one that typically will take most of our new traders out of their position. They'll be like, John, you said if the small triggers are inside of the large triggers, I have to get out with divergence. And that's not the case. You have to be able to step back and say, what is my large chart doing? And what is my large chart expectation? And do I have a good bottom? And do I have strong triggers? And if I do, I might have to ignore a divergence with the small triggers inside. And just hope that the strength of the bottom and the strength of the triggers and my stop below the pivot is enough to save me from anything that might happen up here. And then ultimately, because we were patient, left our stop down here, we get a higher pivot and higher divergence, and we can trail our stop below that. So again, I threw this one in here because the temptation is, oh my God, there's a pivot and the triggers are inside, I have to get out. No, you have to have the proper contextual read of your large chart and what to expect, and use those rules in the right situations, the correct situations. So let's go further. Let's assume you stayed in and you made a bunch of money and you're going long again, and that's all fantastic. Now you're going to get divergence with the triggers inside your large triggers again. And you're going to say, well, John, you said I don't have to get out. And I'm going to say, well, what was the condition of your 13-2 triggers when you were deciding to stay in? Were they very strong, favorable momentum with the small triggers outside in which you can stay in? Or is this the weak, small trigger inside look on your 13-2 chart that tells you you now have to pay attention to multiple divergences and divergences with triggers, small triggers inside of your large? See how that works? Excuse me. So this is it's a very important picture. Strong bottoms on both charts, followed by a trend trade, followed by one little divergence that would ruin your day if you missed all the money. And again, that divergence happened in the context of strong bottom, strong triggers. That's why it can be ignored. The second version of that happened with a weak trigger line configuration on the 13-2 chart. So you have to really start paying attention to what's happening on your 5-1 chart. Now, as we go a little further, again, every situation is different, but there's really only a couple situations. You're going to get into a trade, and in this case, we had put this one in class. We were talking about, the market was so fast and so strong that I got in a little bit early here because I didn't want to try to get those last couple ticks because I might miss it, because the width and the strength was so far away. I was like, it might not make those last couple ticks. So I gave up a few ticks in order to get a fill a little bit early. You really have to have a scorching momentum to get away with that. If not, you want to wait for your area. Anyway, long story short, went short, added on to the position at the mid-band. This timing was a little bit off, but that's where we got short, right below the mid-band. So it was a really good entry. And at the time, look at my triggers. I have one trigger outside the large and one trigger inside. That's okay. But it's a warning that, maybe things are starting to slow down. And then ultimately, we got a higher divergence and the small triggers were inside. So again, I want you to keep this example in your mind, because it's very important to look at the strength of the 13-2 triggers. And again, just like we saw in that last situation, if they're weak, you want to take the exits based on your 5-1 chart. If they're strong, you want to kind of go out kicking and screaming. So, you might opt to stay in, even, and have a stop maybe above the 1-to-1s, or depending on where you got in. If this was your first entry and you had you took some profit and had a break even plus, you might hang on. If the triggers are weak on the 13-2, you're probably going to get out. And this is where you start thinking about, hopefully this exit condition will get the market back up to resistance, so we can start looking for those continuation shorts with the existing trend. See how that works? Again, important to look at the strength of the 13-2 trigger so you know what to do with this situation. This is the opposite, just to kind of show you both. Another example from, looks like June 28th on the S&P. Market was going down in the, let's look at the large chart. Triggers were below the fib, so we're saying, you know, look, we'll take a trade if. But we recognized before we ever took the trade that the triggers are weaker. So we said, hey, we got to get a pretty good fill at the right spot. And we did. And then this is what it's going to look like for you when you have to decide you're going to manage the trade, right? You're going to be in, you put your stop behind the pivot. The market's going to start coming down where you may opt to take some of them off a little earlier if things aren't going right, or if the smalls are in between the large and you have divergence potential. And this is what your stop is going to look like. You know, you're going to have a stop that's maybe 2 ticks above this little 5-1, what we call reversal bar marker, this little yellow thing on the 5-1 chart. It's white on the 13-2 chart, but it's yellow here. And literally, you just put your stop a couple ticks above it, and if you make an up bar plus another up bar, you're going to get stopped out. But you also have a higher divergence. And since your triggers are inside, you already know what's going to happen. It's going to end up going a lot higher. So there's no reason to lose more. You know, in this situation, we had 0.75 of a point, 3/4 of a point risk. I don't remember exactly what it did. I think it went down, but then went up eventually. Anyway, a real good real world example of weak triggers managing a position tight, which you'll hear us say a lot in class. So real good example of that. And then, you know, again, these are, you'll start seeing the same concepts over and over and over and over. Lower divergence, which doesn't mean much. And then the next divergence happens, the second higher divergence. And it's from a fib and your small triggers are above your large. So you say, wait a minute, that's a good bottom, right? And if the triggers are strong, you start taking long trades. So, you know, as you start taking long trades, or, you know, if you took the first one, great. If you were waiting to take the next one, right? You're asking yourself this question. Into a chart line that's in your way on the 5-1 chart, as long as the small triggers are outside of the large, when you have divergence, again, this is, you know, painfully difficult for new people to take. They're like, oh, we have fibs and there's lines and there's stuff in the way. And again, with the context of the good bottom, strong triggers on your larger chart, you can trade in the lines on your small chart. It's going to be difficult at first. You will get used to it. The trick is to make sure you get the right entry, right? At the mid band in between the triggers, because then that's the way you minimize risk. And as you're looking at your divergences and you're wondering if they're going to ruin your life or not, you're going to say, wait a minute, I remember what I'm supposed to be looking for. Small triggers outside the large, I can hang on. And then ultimately, you know, if you got the first one, great, or if you got this one and then, or this one and held on, ultimately, you know, you're talking about, you know, 12, 13 points on the S&P before it ever slows down on your 5-1 chart. And, you know, again, when you reach the edge of fibs, it's not a coincidence that you end up getting one of these patterns, right? And again, just for grins and giggles, let's just say you had divergence and the small triggers are outside. So you said, I'm going to take one more long trade. And then you recognize a lower divergence potential, and then you got out of your long trade. So even at the edge of fibs, not a lot of harm done as long as the configuration is right. Could have kept going, but you'd be very quick, you know, obviously, to manage that type of position. The more you see this, right? And again, I put this one in as from our termination conditions section. Even the strongest trigger lines on the large chart can fail. And that's why, we talk about multiple divergences in the same area. And more specifically, once you start having small trigger lines inside of your large, or God forbid, below your large triggers, even the strongest trigger lines on the large chart could fail. And that's why you have to really pay attention to these terminations. And, again, this is in some other videos, but just because you make it back to the mid bands and fibs doesn't always mean you get a continuation trade, right? But again, proper management, eventually you have to give up if you get a termination condition. So hopefully this will help you guys with your entry and your exit management. I appreciate your time, and we look forward to seeing everybody in class.